Welcome back, folks. Nicholas, cheers, my friend. It's great to have other founding members of Lit Exchange here. Sergio, Yvonne, Sue Ray, Brandon Wright, Quant Trades, welcome. We're going to get started here in just a moment. I'm going to give people a chance to jump in. The former Swiss finance minister is saying that our UBS is at huge risk of collapse, and with it brings the entire country of Switzerland potentially down with it. What's going on, Daniel? It's good to see you guys. Sean, Bacon, Brian, welcome back. John Doe, my friend, cheers. Appreciate your support of the channel. Appreciate your support of Lit Exchange. Welcome once again, everybody. This is the total return swap meltdown. The case for treating total return swaps as secured transactions in disguise. Oh, Brian, you may have already known this. The thing is that when people, especially regulators, start talking about it on mainstream media, it usually means the shit's about to hit the fan. That's why this is exciting. Happy Sunday, Jason. Happy Sunday, everybody. Welcome back. All right, folks. Let's dance. See, this article just came out yesterday on Reuters. And the former Swiss finance minister is warning about the size of the now enlarged UBS. And people need to keep in mind that UBS is this big because of the collapse of Credit Suisse. Credit Suisse collapsed because of the collapse of Archegos Capital. At its height, Archegos Capital had over $20 billion in assets and significantly more leverage. But in the spring of 2021, in major part through to its use of total return swaps, they basically sparked a $30 billion sell-off like that. That left many of the world's largest banks holding a bag of toxic derivatives. And for example, Mitsubishi UFJ Group lost $300 million. UBS lost $861 million. Morgan Stanley, $911 million. Nomura Bank of Japan lost $2.85 billion. And of course, the biggest and baddest of them all, Credit Suisse, lost $5.5 billion. Meanwhile, Archegos itself lost over $20 billion in a 2-day span. In 48 hours, $20 billion was Thanos snapped out of existence. These losses were made possible due to the unique characteristics of total return swaps and Archegos' formation as a family office. Both of these things, the family office formation and the use of total return swaps, permitted Archegos to skirt trading regulations and reporting requirements. They essentially purchased beneficial ownership in large amounts of stocks, particularly Viacom CBS and Discovery Inc. on credit. And they were also able to short a significant number of stocks such as Gamestop, as one example, which is held in a basket of securities with many other stocks, such as AMC, MMAT, etc. Costs, you get the idea. And under Regulation T of the Federal Reserve Board, up to 50% of the purchase price of securities can be borrowed on margin. So to avoid these rules, Archegos entered into total return swaps with these banks, where the banks were the actual owners of the stock, but Archegos would bear the risk of loss should the price of the stock fall, and they would also reap the benefits if the stock were to go up and make a distribution. Archegos, of course, would still have to pay the transaction fees, but these total return swaps permitted Archegos to buy massive amounts of stock and leverage in both long and short positions without having the initial margin requirements, thus, of course, making them massively leveraged to the tits. This argues that the total return swap contracts here are analogous, for lack of a better word, and should be recharacterized as what they really are: secured transactions in disguise. Essentially, the banks are lending money to enable Archegos to buy stocks, and they're doing this with many other companies around the world, and they're simply retaining a security interest in these stocks. So a recharacterization here should place these transactions back into Regulation T and the margin limitations. But this also offers another contract law approach that is more draconian, in the sense that if the structure of a contract violates a regulation, then total return swaps could be declared void as against public policy. Now, what's happening here is that the former Swiss finance minister is warning about the size of enlarged UBS. In reality, UBS is now being seen as being too big for Switzerland following its takeover of Credit Suisse, according to the former Swiss finance minister, Ueli Maurer, who's just said this yesterday, and with measures needed to reduce the risks of the enlarged bank. He said, if you look at the numbers alone and compare UBS with the Swiss economy, it is too big. Therefore, the risks must be reduced. And for reference, guys, the balance sheet of UBS alone is double the size of the entire annual Swiss economic output. That's $1.7 trillion, giving them an exceptional weight for a major economy, according to Reuters. And honestly, should the bank fail, there are no local rivals left to absorb it, they say. While the cost of nationalization, which means a government takeover of the bank, could severely damage public finances, experts have warned. Reducing risks was primarily the responsibility of shareholders via their choice of board members. And now we got guys like this, actual financial experts in the field, coming out to saying that UBS has to take responsibility and not taxpayers. And this guy left office just months before the actual collapse of Credit Suisse in March of 2023. He said that legislative measures must also be examined. So in case you didn't know, the Swiss government last year, in 2024, put out new plans to increase capital requirements for UBS and three of Switzerland's other big banks in order to help make the financial sector safer after the collapse of Credit Suisse. Good evening, Trevor. It's great to see you, my friend. CRX, you as well. God bless. Dufresne, cheers, my friend. Good Vibes of Palm Coast says, thanks for the videos, boss. Can't wait till we go live with Lit Exchange. Neither can I, my friend. It's been a long time coming, over 3 years now, but good things are worth the wait. And if it were easy, anybody would do it. Let's put it that way. But it's not. These good things take time. So the thing is that the new details here, guys, of the exact capital requirements for the increased margin has not yet been made public. But UBS has been fighting it tooth and nail. And there's a possibility that UBS could have to hold up to $25 billion in additional capital, aside from what's already being held for initial margin requirements. There's potential over $25 billion in additional capital that would have to be held by UBS here. And of course, they're fighting that tooth and nail. So this guy said that if the capital requirements were too high, the Swiss banks would no longer be competitive and may look to be based elsewhere. But for the Swiss economy, with their international multinationals, people that live all around the world, a large bank is a locational advantage, but the risks must be minimized. Of course, UBS Bank themselves declined to comment on this interview, but the CEO of UBS, I think his name is Sergio, earlier this month, told a magazine that UBS had enough capital to cover any potential problems. So take that for what you will. That means I think that they expect to lose a significant amount of money. UBS supported many of the Swiss government's proposals to improve banking regulation, but they had to be targeted and proportionate. At the same time, the only way that UBS actually agreed to take over Credit Suisse was if the Swiss government agreed to give them and subsidize them with over $9 billion should they incur over $4.5 billion in losses. As of yet, we have not seen this happen, but the deal is still on the table. That was a whole part of the conditional acceptance of the takeover of Credit Suisse by UBS. It is in writing. You can find that on dozens and dozens of articles. And I explained here in depth the total return swap and how Archegos was able to use it. And I explained it as simply as I possibly could. And you can see here, Archegos holdings were primarily in the form of total return swaps, where the underlying securities, stocks, are held by the banks. This meant that Archegos did not need to disclose their large holdings, while if it had transacted in regular stocks, it would have had to do so. They were heavily leveraged and did business with multiple banks, which was what provided them the ability to hide their long and short positions. We have here the confessions from the head trader at Archegos Capital, detailing a manner in which their positions were manipulated to benefit Archegos under the direction of Bill Huang. And Huang and himself and three others were brought up on RICO charges, racketeering and fraud charges. And I'll read this to you briefly because I know the text is kind of small. They said, from March 2020 through March of 2021, I was a head trader at Archegos Capital Management. During this time, I and others executed trades that allowed the fund to amass market power and certain securities traded on U.S. exchanges. Archegos used security-based swaps to gain exposure to U.S. securities, while concealing the true size of the fund's position from the market and our trading counterparties. Once Archegos gained market power in these securities, I and others used this power to trade in such a way as to artificially manipulate the price of these securities. Acting at the direction of the head of the fund, Huang, I traded to increase the prices of names in which Archegos held long positions, and reduced the prices of securities in which the fund helped short positions. So, of course, they pumped stocks that they were long on, like Viacom and Discovery, and they dumped and reduced the prices of securities artificially in which they held short positions. For example, Gamestop and anything else that is held in the same sort of basket derivatives, such as AMC, COS, Sundial, etc. He said, I did this for example, buying large amounts of stock when the price dropped in response to negative news, or trading pre-market when I knew the fund's activity would have a greater impact on price. I manipulated the price of these securities in order to influence others in the market to buy or sell the securities in ways that would benefit Archegos' key positions and increase Archegos' purchasing power through variation margin. And he goes on for hours and hours in this 51-page document, court case filing, in which Huang and 3 of the others were brought up on their racketeering charges. In case you're unaware, Steve says, your hard work is much appreciated. Thank you, boss. You're very welcome, my friend. I'm very happy to be able to provide the information possible. In case you're unaware, basket options have become integral to the investment landscape, says Religare Brokering. They are a brokerage overseas. By using these basket options, investors can capitalize on the collective performance of multiple assets, providing them with increased flexibility and potential profit. Same goes for potential losses. A basket option is a type of financial derivative that offers investors the opportunity to speculate on or hedge against a group of assets collectively, rather than relying on the performance of a single asset. It involves bundling several underlying assets, including stocks, bonds, or commodities. This option provides investors with a broader exposure to market movements and reduces their reliance on the performance of individual securities. Investors can choose a diverse range of underlying assets to include in the basket, such as stocks, bonds, or commodities. This allows for customization based on individual investment strategies and preferences. And when total return swaps are used on these baskets of securities, of course, they can be used to leverage upwards or downwards on many stocks, whether they be long or shorts. Some of the benefits, of course, diversification, customization, it's cheaper, and they can manage multiple positions. The disadvantage is that they are complex, making them difficult to understand and evaluate. Evaluating the basket's options underlying assets requires a deep understanding of market trends, individualized performance, and their correlations. This complexity can increase risks, etc., and they may have limited liquidity, unlike individual options actively traded on exchanges. Limited trading volumes can make it challenging for investors to enter or exit positions at desired prices, potentially resulting in higher transaction costs and less favorable outcomes. They can suffer from a lack of transparency in pricing, and their valuation depends on the performance of multiple underlying assets. The lack of transparency can challenge investors in determining whether they are paying a fair price, potentially leading to overpaying or undervaluing it. That is just one of many ways in which multiple stocks are gathered together in order to go long or go short. And you can see here the risk level depends on the volatility of the underlying securities in the basket. If the securities are highly volatile, the option could be riskier. The risk is tied to the volatility of the entire market index in comparison to index funds, which is less volatile. So these basket securities are much more volatile, hence the reason why Gamestop and AMC and FFIE, you get the idea, SLV, the silver ETF, stocks like this, costs were made position close only when the volatility went through the roof. Hedge funds and family offices in 2021 began to lose hundreds of millions and billions of dollars, to the point that broker-dealers were nearly completely insolvent. Hence why Robinhood, IBKR, E-Trade, Charles Schwab, and hundreds of the world's largest brokerage firms took away retail's ability to profit and took away their ability to buy more of stocks like SLV ETF, GameStop, AMC, because this whole basket of securities was being heavily shorted by companies like Archegos, Melvin Capital, Tiger Capital, the list goes on and on. None of this, many of these positions have been closed out, but we know that Citadel bailed out Melvin Capital and likely bought many of their short positions. And in the same way, when Archegos collapsed, Credit Suisse took over their bag of toxic derivatives. Then, of course, Credit Suisse was no longer able to handle this, and they collapsed as well. UBS took over their bag of toxic derivatives. It's a game of hot potato. Now we're seeing something akin to that, in which UBS is under great scrutiny, and they are now the ones holding the hot potato. We are seeing the Swiss government come out and increase their initial margin requirements. They have a contractual obligation to bail out UBS for up to $9 billion if they exceed $4 billion in losses due to these these swap positions and toxic derivatives. And that has not yet occurred, likely because these total return swaps and bullet swaps are still being rolled over and held in perpetuity. They will continue to be held for a significant period of time until they can try to figure out a way to get somebody else to buy them, or for them to close them out without making Switzerland, the entire country of Switzerland, and UBS both insolvent, thus creating the situation in which all of the Swiss taxpayers would have to bail out UBS. Contracts for difference are one way in which significant collateralized asset issuance can compare to what they might be replacing. There is a way in which these banks and institutions can use contracts for difference, which are basically called CFDs in the industry. And one of the potentially disruptive qualities of tokenized securities, such as those held by FTX and Bittrex against AMC and GameStop, which we found were backed by absolutely zero when FTX collapsed, is that they could steamroll the large retail Forex market and contract for difference industry, which is well established and generally offers tradable instruments that are not saved to a blockchain. They can use these tokenized securities that are often not backed by anything, as was proven when FTX collapsed. We saw their balance sheet. They didn't hold a single fucking share of AMC and GameStop. Meanwhile, they were selling tens of millions, if not hundreds of millions, of shares of the stock in order to be shorted by companies like Archegos, Melvin Capital, Citadel, etc., Virtue, you name it. This is well established and generally offers these tradable instruments, and they're not safe to a blockchain, meaning that these tokenized securities are ways to manipulate the stock market. Broadly speaking, it says here, CFD brokers also lag crypto exchanges in terms of sophistication and product depth. For example, CFDs are not available in the United States. They have long let users trade a synthetic instrument mimicking a company's stock prices like Apple, Microsoft, Tesla, AMC, GameStop, but are at heart IOUs issued by a retail brokerage, not traded on an exchange, meaning they're traded in a dark pool. They're IOU creations of synthetic shares traded in dark pools and are non-transferable. This adaptability of well-capitalized contract for difference retail brokerage firms such as IG and CMC Markets and Plus 500 should not be underestimated. Ladies and gentlemen, it is things like this and actuality of the fact that this will never go away until we make it go away. Until retail investors start investing and using a brokerage firm that does not allow your orders to be traded to dark pools on behalf of wholesalers like Citadel and Virtue for them to front run your trades and use tokenized securities to issue synthetic shares and to naked short stocks legally via the market maker exemption rule 203B III. Well, it's just going to continue. Hence why over 3 years ago, we began the development of Lit Exchange. Lit Exchange is an upcoming stock and crypto brokerage, which we are creating for the purposes of routing orders directly to lit markets and avoiding dark pools through wholesalers. It is a game changer, and this is the first time in the history of the world in which you, the retail investor, has the ability to actually own an upcoming stock and crypto brokerage before it launches. This has never been done in the history of the world. I am proud to say that I am the CEO of the first company in the history of the world that is creating an upcoming stock and crypto brokerage that is giving you, the retail investor, an opportunity to actually own the company before our launch and IPO plans. When we IPO, as planned, you will then have the opportunity for a significant liquidity event in which, through our increased valuations and our initial public offering on a public stock market, you will then have the opportunity to sell your shares for what we believe to be a very significant profit. So far, over 290 retail investors have invested over $500,000 in Lit Exchange, 100% organically. We have not spent a single dime on advertising, not a single penny. The only way that so far that this has been advertised is here on YouTube and Twitter. And this has never been done in the history of the world. Once we start putting money behind this and getting this out there on larger outlets, we truly believe that a lot more retail investors are going to be smart enough to understand what's going on and actually pile in to the Regulation CF under the Jobs Act crowdfunding campaign. Again, this is not some GoFundMe. This is not a donation. This is a private equity investment in which you receive a significant number of perks and benefits and the opportunity to become a founding member in an upcoming stock and crypto brokerage before our launch and before our IPO. If all goes well, we expect to launch here at the end of 2025, possibly the beginning of 2026, but we are working really hard to expedite that and make that happen as quickly as possible. So again, ladies and gentlemen, I urge you to do your due diligence, go to litexchange.com and check this out. Because this is not something that's ever happened in the history of the world in the past, and it is unlikely to ever happen again in the future. With that being said, I wish you all peace and wealth. I hope you have a fantastic weekend. I see a lot of you there in the comments right here below are actually founding members already. Cheers, my friends. You are the first to be able to do this in the world ever. And I very much look forward to our launch and eventual IPO. Cheers, ladies and gentlemen. Have a great rest of your weekend. Typo Negative says, let's get lit with Lit Exchange. Thank you, Luke. Appreciate it, my friend. You know, I gotta rock the linen sport coat. It gets hot over here in Texas, even in the winter. Turbo, can I turn my volume up, my friend? I believe my volume up is up very, very high already. I'm afraid if I turn it up any higher, it's going to crackle and pop way too much. Cheers, Quant, Joel, Peter, Yvonne. Thank you very much. Trevor asks, Roaring Kitty, RC, Ryan Cohen has been quiet. Feel there is much going on behind the scenes. Yeah, RC has been quiet, and I'm not entirely surprised to see that. I think that something big is coming in the future. Just not sure, of course, what that is. Thank you, everybody, again. Joel is a proud owner of Lit Exchange. Joel Patrick. Cheers, my friends. It's a pleasure to be in partnership with you in Lit Exchange. Flavius says, get the damn money printer out. Jerome Powell. Kenny Griffin. UBS. Have a great evening, everybody.